Welcome to the Trading of Things channel on the week beginning the 2nd of February 2025. It is episode number 4. And then here are the objectives. We'll go through the BIS triennial central bank survey of forex market in 2023. Triennial means recurring every 3 years. Therefore, the last survey was published in 2019 as per our last video. You can take a look on our last video where we had a fascinating report by some great, I don't know whether they are scholars or, but some people worked on that report, summarized the report on the FX market. The report that we went through was summarizing the BIS report for then. So we'll talk briefly about swing trading as well. Last but not least, we'll touch on the trade setups. Okay, as per usual, here is our disclaimer. The following video content is for educational and informational purposes only. It is not intended to serve as financial advice or to replace independent research. Users should be aware that trading carries risks and they should consult with a licensed professional before making any financial decisions. We'll jump right on to discussing the key statistics for the global forex market in 2023. And as indicated, meaning that um, this survey is done every 3 years. The last one before this one, it was published in 2019. So 3 years after, then we have this one for 2023, and then we'll be looking forward to the next one. I think probably it will come out in 2023. So the key statistics for the global forex market in 2023 are as follows. The daily turnover for 2023 was 7.5 trillion US dollars, up from 6.6 trillion in 2019. It represents a 14% increase over 3 years. This still represents the biggest daily market volume in the world. So you can extrapolate that extrapolate that daily average volume to a week, month, and year. Really, ridiculous amounts will come up. So the FX market is still the biggest market in the world. So we'll take a look at the breakdown by instrument. And in this case, probably I could have called it per category. I think it's more representative than by just saying instrument. I think instrument is too wide. So the different categories of instruments, of which we have the spot transactions, we have the forwards, we have the swaps, and other derivatives. We can see that the category that takes the cake falls under the FX swaps, which is sitting at 3.8 trillion US dollars. And then it's followed by the spot transactions, and then outright forwards at 1.2 US trillion dollars. And then last is the other FX derivatives. I think the spot transactions outright forwards are entered into by big money. These may include your these may include hedges for future transactions, whereas retail traders are likely to fall under the other FX derivatives category. In this case, the contracts for differences. Retail traders, I think, we are likely to fall under the last category, the other FX derivatives, as most of the trades that we do, they fall under the contracts for differences. I think at some point in time uh, we'll go into these types of instruments just to gain an understanding as to what it relates to. But I'm more convinced that most retail traders would fall under that last category, but under the contracts for differences. And then the most traded currencies, we have the US dollar, which is still the dominant currency in the FX market. The the matrix does not compute in a simple way when you add the 88%, the 31%, the 16.7%. I think, or rather, will someone help us with how does the methodology work? Basically, this methodology or rather, these stats are coming from the BIS report, as indicated in our introduction. So I think they've got a certain methodology. So it's not just a simplistic saying we'll add 88%, 31, 16.6, then it should add to 100. No, it doesn't compute that way. Probably if someone is out there to assist us on how do they come up with these percentages. I'm sure it's a bit complex. Obviously, it will need someone to delve into the assumptions and then the workings of that methodology. I'm sure it makes sense, but it's not as simplistic as your normal percentages. As we know, it normally should add up to 100. In this case, no, it doesn't. Still continuing with the most traded currencies. Okay, the British pound sitting at 12.9%. What's interesting and is its stark is that the emerging market currencies are not traded a lot. At the top we of the emerging market currencies, the one which is at the top is the Chinese yuan. It's sitting at 7% of trades, but it's up from 4.3%. And then you have the Indian rupee at 1.7%, the South African rand sitting at 1.1%. It would be interesting to see where I think the Russian currency, I think is the ruby. It would be interesting to see where it's sitting, as well as um, I think Brazil is the peso. Yeah, it would be fascinating to see where they are sitting. Another trend which is emerging, as you can see, that the Chinese yuan grew from 4.3% in 2019 to 7% in 2023. I think this reflects the economic growth of China and the impact that China is having throughout the world as they are expanding their activities in different countries, building ports in and especially your emerging economies. So I think the growth here reflects the effect of the economic growth in China and what China has been doing outside. So their growth outside of China, I think, is being reflected here. The major pairs which are traded in the FX market, you have the Euro USD, which accounts for 22% of total turnover. The USD Japanese yen, 13% of total turnover. GBP USD sitting at 9% of total turnover. Emerging market pairs USD Chinese yuan, 7% of total turnover. A similar trend is observed on the traded pairs. The major currencies dominate the major pairs. in line with the trends under currencies, the USD Chinese yuan is pegged at 7% of total turnover, which is consistent with the 7% that we saw on under currencies, because the Chinese yuan was sitting at 7% as well. The trading hubs, where most of the transactions are taking place, we find that Planet FX market has its major hubs in London, New York, Singapore, and Hong Kong. This is not surprising given that the US and UK are developed countries and exercise a lot of control over the financial markets. Okay, the trends, the trends which were observed up up to 2023 was the algorithmic trading, that it accounted for 70 to 80% of spot trading volume in major currency pairs. So the use of EAs, the algorithmic trading, that's where we talk of the bots, where bots can place trades, they can close trades, they can decide for themselves based on whichever settings. So we've seen the growth of that for spot trading. Spot trading is done mainly by I think it accounts for mainly foreign exchange transactions, especially by businesses. So businesses, I think they go to banks in order to settle these foreign transactions. So they are settled at spot rates at under that spot trading. Because obviously you have the sell and the buy rates, but yeah, so we find that most of them are sitting there. And then another trend which came up under the retail and under FX market is the retail trading growth. Retail traders account for 10% of total volume driven by online platforms and mobile apps. We touched on this even last week, that there was a growth up until 2019, but so this growth has continued in the following 3 months, up in the following 3 years, up to 2023. So the growth is still there, and then it will be fascinating to see if the same growth is maintained in the next triennial. So we will keep an eye on that. Another trend is on emerging market focus. Increased trading in currencies like the Chinese yuan and Indian rupee. We This is consistent with what we have observed under the major currencies and then the major pairs, because we've seen the Chinese yuan, it's becoming active in the FX market, and its growth is, yeah, it's been growing. So we I should imagine this growth will continue for the foreseeable future, for the next decade, so long as China is still growing and it's still expanding its operations even outside of China. The challenges in 2023 are the geopolitical tensions and central bank policies led to sharp currency movements. Well, volatility, I would like to think, is the lifeblood of this market. Volatility is what traders of all sorts wait for, especially speculators. Let me put it that way. Uh, and then, whereas with the your normal manufacturers, your sellers, your exporters, your importers, it's mainly for hedging purposes, whereby they'd like to cover They'd like to cover themselves the risks of changes in market value due to changes in fair value of the currencies. However, so from your normal manufacture from your normal exporters and importers, so basically is to hedge them their transactions, and then whereas for speculators is for profit making, and volatility is the lifeblood of the speculators. That's what we need in the market. This is what we need for movements to occur, for trends to start, for trends to change. So you need volatility. Another challenge basically it relates to regulation. Stricter rules in regions like the EU and Australia impacted brokers. It sounds like the okay. What I've observed tends to happen is that the developed countries, the number one countries, yeah, basically the developed countries, they these markets are like fully developed in these countries, and then they come up with regulations to rather over those activities, in this case over the financial services market and industry. And then what tends to happen is that your developing countries then they would follow the rules which had been set. Because I'm in South Africa, and what happened of late is that we've seen the FSCA, the Financial Sector Conduct Authority, which is the regulatory body, has also been cracking the whip, especially even over retail trading activities, whereby they need um, licenses over certain activities, such as acting as an intermediary or offering financial advice. So um, this may have come as an annoyance to some of the traders. However, we are following on international tracks on their steps, um, as they have they are at the forefront of they are spearheading this industry. So I expect a whole lot of countries to where the FX market is actually is active, to also follow on regulation. In Africa, I don't know how much regulation is there, and we'll touch on this probably next week just to see the FX market in Africa, its impact, its how active it is, which are the most uh, which countries are most active in that market, and the like. So we will see. So I suppose this is one of the things we're going to touch on. The last challenge relates to inflation. Rising rising global inflation influenced currency valuations and trading strategies. Normally, when inflation is high, higher interest rates are introduced to tame the impact of high inflation. This in turn affects the currency valuations and often leads to noticeable movements in affected currencies. So these are some of the challenges. And I should imagine almost year on year in inflation is it's also one of the things which is targeted by the reserve banks of different countries, obviously for their own policy objectives. So those were the challenges in 2023. So the conclusion, the 2023 forex market saw continued growth driven by technology, emerging markets, and increased retail participation. The USD remained dominant, but emerging currencies like the Chinese yuan gained traction. Traders should remain cautious of volatility and regulatory challenges in the future. So the triennial survey is expected next year in 2025, and the report may be published in 2025 or 2026. Here we come to the segment where we talk about swing trading strategy. We went over the differences between swing trading strategy and daily trading strategy in our last video. Swing trading entails holding of trade positions for more than a day to a few weeks. It is the dominant strategy due to its flexibility. It is suitable for retail. It is suitable for retail traders as most retail traders have other commitments. Swing traders aim to capture short-term price movements within a trend, typically holding positions for a few days to a few weeks. And this approach allows traders to avoid the pitfalls of long-term investments while also capitalizing on short-term market fluctuations. One of the key advantages of swing trading is its flexibility. Unlike day trading, swing trading doesn't require traders to constantly monitor the market. This makes it suitable for individuals with full-time jobs or other commitments. Swing trading also offers the potential for higher returns compared to long-term investing, as traders can take advantage of both upward and downward price movements. Swing trading is considered one of the most popular trading strategies used by retail traders, as it allows them to capture medium term price movements while requiring a relatively lower time commitment compared to day trading or scalping, making it suitable for individuals with full time jobs or limited trading hours. Most swing traders rely heavily on technical analysis to determine entry and exit points. One of the key advantages of swing trading is its flexibility. Unlike day trading, swing trading doesn't require traders to constantly monitor the market. This makes it suitable for individuals with full-time jobs or other commitments. Swing trading also offers the potential for higher returns compared to long-term investing, as traders can take advantage of both upward and downward price movements. Key points about swing trading and retail traders. Number one, its accessibility. Swing trading doesn't demand constant monitoring of the market, making it manageable for traders with limited time availability. Number two, under the technical analysis focus. Another key point is that swing traders primarily use technical indicators and chart patterns to identify potential trading opportunities, which is a common skill set among retail traders. Another key point under risk management, the longer holding periods in swing trading can allow for better risk management compared to shorter term strategies like scalping. So those are some of the uh, some of the pros relating to swing trading. I think personally, yeah, I, I agree with the sentiment that most retail traders fall under swing trading. They use the swing trading strategy. Um, and we are not bashing the daily traders. You guys are in your lane. Enjoy it, and we wish you the best. Um, and we are in the swing trading lane. and we also wish ourselves the best. So we're not bashing anyone, any strategy. So long as it's working out for you, we are happy for you. But as it said that most retail traders, they use swing trading strategy, and it makes sense because of our commitments, full-time employment, running business, this or that. So you don't have time to be always keeping an eye on on the market. And yeah, so whichever works for you, so long as you're making money, we are happy for you. But for most traders, swing trading is the way. And for the purposes of the swing strategy here, the it's premised upon the fact that it's premised on two risk management strategies. Number one is that we will use the minimum capital requirement for each trade of $10, 10 US dollars for each trade. And then we'll also apply the minimum lot size of 0.01. So that covers us. And I think $10 for most people, even when you lose it, it's not as bad as 20, 30, 40, 50, 100 US dollars. So it's a game of patience. And if we can also minimize the emotional damage, which is often experienced by higher capital and higher lot sizes. So if we marry um, lower capital and lower lot size to patience, I think we'll definitely enjoy this route, this adventure. Because if you think about it, even um, big financial institutions, when they talk of returns, they're talking of um, uh, nothing spectacular per se, because so long as some of them have beaten inflation, it's like it's a great performance. And then you also tend to hear of the financial institutions, I think like your Renaissance Technology, where they consistently produced about 60 something percent annually, um, which is great. Uh, so it shows that when it comes to return, what's spectacular and what retail traders have in mind is at great variance. Because I should imagine with retail traders, those seem like mega returns. I mean, you've beaten inflation, you produced about 10%, which with big institutions, it's something huge. You've beaten inflation. Probably, if you like, you produced about 20%. I'd like to believe that with this strategy, so long as we're minimizing um, the the capital requirement as well as the lot sizes and a whole dose of patience. I think this strategy is likely to produce even more than the like your average returns, especially by the big financial institutions. Yeah. However, we will see as to how that goes in the course of this year to see whether that is possible. All right, we're going to the interesting segment on setups, forex trading setups. So these are the ideas that I'll be having regarding my view of the market and as to whether which strategy should to identify which pairs, which instruments have potential, and then at what levels probably those trades should be taken, and then the take profit. For the stop loss, as I indicated that um, so long as we are willing to lose that entire $10, it's fine even if we don't put it up there. I think we can make peace with it that it's gone, and then however the return is likely to be more than that. And what I'd like to do probably in future is to come up with a demo account just to also enter these trades and then show as to how they'll be doing. And like now, I'll just be showing you it moved here and here. But on the demo, at least we'll be seeing live. We'll be seeing live as to how the how the trade is doing, and then ultimately is also just to come up with the live with the real account, and then we'll use that for the purposes of 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 these videos, just to see as to how much money are we making or losing. All right, we'll start with the prior setup review. So last week I had four I had four trade setups which I recommended. We had the US oil, we had the US 30, we had the AUD CAD, and we also had the German 30. So we just want to see how how these trades went. So to do that, we'll go to trading view. All right. Oh. So with the US 30, let's see, US 30 WTI. All right. With the US 30, I I I recommended a buy a buy a buy trade, and then what would become clear or apparent is that I think we went a little bit earlier, but the trade idea is still there. I think what happened was we used this line instead of going down to this one, because you never guarantee these things, by the way. You never guarantee these things. So instead of, yeah, probably we could have used at least this line, because this is the area of interest, which we should have put it this way. But nothing can be said 100% with certainty. So I think this is the area of interest, and it's supported by the other prior resistance level, which happened around October. It happened around October. It also happened around November, as you can see. So this is the area of interest, and the strategy is still to go up. So uh, I wish we had opened it on the demo to see as to whether it would have wiped out that 10 US dollars. Because if we had survived this, the strategy is still on for going up. However, if it would have wiped us, then we would have gone out. We're going to try for another one. So as to whether it worked or not, um, I'll be conservative and say it didn't work because probably it would have taken us out. So we'll enter another one. So for this week, this for this week, let me also include trade setup. So strategy. The strategy is to enter, or the strategy is to buy, and then entry at, let's see, 72,520, 72.520, and then take profit. Take profit is at somewhere here, minimum of 78. Let's see. Yeah, 79,369. 79,369. That's the strategy. So this trade, we still we're still going with it. It's still going up. We just need to hold on to it until it goes up, at least based on our analysis here and based on this area of interest. And so far, you can see the wicks here showing the big fight between the bears and the bulls. And so far, the bulls have been winning over the last two trading days. Yeah, the bulls have been showing, but it's not yet at the level where they are bashing the bears or the bears have given up. It's still close to the area of interest, so we will see how that works out. Um, the second one was the US. This is very interesting. So with the US 30, I recommended that it was going to go down. And one thing you'll notice is that although you can identify an opportunity that um, the market is going to go to a particular direction, it does not normally start moving immediately. It takes time. This is why we say patience is a trader's virtue. It takes time. Since the last recommendation, which was on Sunday, imagine we had the whole full week and it was threatening to go up. It was threatening to go up until on last Friday. That's when it came to our level again. That it like your entry level that was put out last week. So it hasn't moved yet, and we expect it probably even this entire week. It will keep on ranging for a bit until maybe next week. That's when it's gonna go down. It's patience. It's swing trading. We wait for it until it capitulates. So if there is one lesson which we can pick from this is that even though the opportunity is there, you can see it. It doesn't mean that it happens immediately. So for this one, we will hold it, and then uh, so that idea is still there. So the entry, just like last week. So I'll take this as that it wouldn't have taken us out. So I'll treat this setup as like it's still working itself out. It's still work in progress on its way down. although the movement hasn't started as yet, because it's still ranging or hanging out at our initial recommended level. So the strategy is still a sell. Okay, let's do this strategy. It's still a sell. So that's my view on it. And then we're going to the AUD CAD. AUD CAD. All right. AUD CAD. Wow. Now, when you talk of beautiful, beautiful trades, this is one. This is one beautiful trade because you can see the sell strategy. The entry was at 95.91, which is where the blue line is, and just look at it. It did go down, and then the take profit, it also hit it. So this was par excellence. This was par excellence, and if you had put those take profit levels as well in the trade, yeah, one would have got this one. And then based on this path which I drew here, that it was going to bounce off on this level, and it followed it exactly. So now we'll just observe it to see as to how far it's gonna go. So now probably we can um, change the entry to this one. What is this? Yeah, to 900, 2.9, 2.9, 2.9, and then take profit. The minimum would be where we we entered that previous trade. So the minimum take profit should be sitting at 90591. So we'll see how it goes. And that's it for the AUD CAD. Let's see the German 30. And the German 30. All right, the German 30, we can see it as per the conventional price action um strategy. It had the three, it struck the upper band, the upper the upper band of the um bullish trend as per this line here. This was the third strike, so we recommended that it should at 21,392. 21,392, where it was this, yeah, it was just below that red. So basically, I think it wreaked havoc against that recommendation. Okay, so basically we recommended when it was sitting here. Okay. And then last week, as you can see, it went up. And what's interesting is that if you use the shorter parallel channel bullish trend line here, you can see that even on that one, it went to strike it three times, which is one here, second is here, and the third is here. So we are still of the opinion that it's still going to come down. So for this one, uh, I think probably it would have also taken out the 10 US dollars, or maybe not. But to be conservative, I'll just say, okay, maybe it took it out. So we'll just say that it didn't work out. But the idea is that it's still going to come down. So this will change our entry as follows. This will change our entry as follows. Strategy, it's still a sell. However, for the entry, we'll use where it closed, which is 21.654 as an entry. And then take profit, we'll leave it as such because I think it's still going to come to this area of interest. This is likely to be a big, big, big move. So we'll leave the take profit at that level. So we'll see how it comes up over the next few weeks. Over the yeah over the next few weeks, I suppose. So we'll be monitoring that. So based on this, um, based on this, right? So trading view, I said we have the BTC ETH, ETH, yes, BTC ETH. We have that potential one. And as you can see, this is the area of interest. It already bounced off. Um, so if it comes back, yeah, I think we can still enter and then aiming for the take profit of 33,000 as a minimum. And then probably can go for the other take profits using the Fibonacci levels. So we have that, and then we also have the Euro GBP. Okay, the Euro GBP, it's still hanging around the area of interest. It hasn't completely come off it. So um, I think that it's still gonna bounce and then go up, and then let's actually put the setup as follows. Set up strategy. It's a buy, entry level, entry level. Yeah, you can, yeah, within this range, but okay, let's put it here. 0.83690, 0.83690. Then take profit. The minimum that we can expect is that it should go to 84, 500. So that's my take. The the AUD CAD we already discussed it. AUD CAD we already spoke about it. Um, yeah, so that's it for the week. Thank you very much for taking your time. to check out check out this video, and I'd also um, ask for your comments, for your likes, and all these wonderful things. We're still starting. I hope that we have the stamina that often comes with this kind of adventure. So I wish you all the best until the next video. Have a great, fantastic, fabulous, epic week. Cheers.